Hi everyone, this is Tim Melvin of the Tim Melvin Deep Value Reports and the Banking on Profits newsletter, coming to you from down here in Central Florida, where we're starting to get back into our 92, 93, a little bit of sea breeze, afternoon thunderstorm kind of weather. I absolutely love this time of year. The hotter the better. Bring on the heat. I'll just work from the beach for a few days. Anyway, market's been basically flat this week, and I apologize. I was supposed to have a video out this weekend, but with Mother's Day and all the craziness running around, I swear May is like Christmas all over again around this house. 3 of the 5 of us have a birthday in May. Daughter's flying in next week. She and her brother are 4 years and 1 day apart. I guess we're going to roast a pig and have a little party down here. You've got Memorial Day, you've got Mother's Day. It's just craziness every weekend. So again, I'm late with the video this week. The chatter around the markets really remains, I'm going to just unchanged. It's the madness that's going on between the ECB and Greece, and whether they will or won't default, whether they'll stay in the euro, and we'll see how it all plays out. Everybody involved is acting like idiots, but as we've said, idiots need banks, so we're just going to hold on to our Greek banks and try to ignore the wild day-to-day swings in the 2 Greek banks that we do own in the international portfolio. It's been a fun and interesting ride so far, to say the least. A lot of talk right now about the fact that it looks like we are going to have a year-over-year decline and a quarter-over-quarter decline in corporate revenues here in the United States. Lots of things being blamed for that. Of course, oil prices are playing a very big part, because energy is a big part of the S&P 500, and their revenues have been slashed by about a third due to falling oil prices. So certainly oil gets some of the blame. Higher dollar is hurting multinationals in the first quarter earnings. And part of it just has to be assigned to the fact that, guys, the economy is not that good. We're just kind of plugging along there, still trying to figure out what all the excitement was about last Friday's jobs report, because I read it and the numbers looked fairly pedestrian to me. I was not all that impressed or blown away. When I talked to Louis Navalier a couple weeks ago, and Louis is brilliant on the economic stuff, in addition to being one of the best growth stock investors out there. Louis told me that he says we have a serious double counting problem going on out there. So if you're working 2 jobs, you count twice, even though you're working 2 jobs just to make less money than you used to make in your 1 job. You get counted twice. So the jobs picture, not as bright as the official numbers might have you think. So I have no idea where all that madness came from last Friday. But we're selling off here today, so they'll trim some of those gains back. So about flat on the S&P 500. Same for the all-world URTH index. However, the leader, again, this week is our small bank index. So the community bank stock index, symbol QABA, is up 1.5%. And I'm not surprised at all, because just looking over our own portfolio in the Banking on Profits service, earnings in the first quarter were fantastic, almost across the board. We showed revenue increases. Net interest margins stayed pretty stable. We showed some growth in loan demand, growth in deposits. Earnings were higher, dividends were being raised, people were buying back stock at a discount to book value. There was just very little bad news at all in the sector. It was a fantastic quarter for small banks. Now, last week, in the middle of Buffett Palooza and the SON conference and the SALT conference and everything else that took place last week, there was a conference down in New Orleans that, from my point of view, is probably the most important one of all. That was the Gulf South Bank Conference, where all the bankers go down there to New Orleans from the Southeastern regional banks. They get together and they talk about what's going on in the industry. Guess what? This year, dominated once again by talk of merger and acquisition activity, with many of the bank CEOs discussing the fact that, look, smaller banks pretty much are in a position where they need to sell. Only the strongest, most solid small banks, say less than $500 million in deposits, are in a position to go it alone. And those are the ones that just absolutely dominate a small or rural community and are the bank of choice in that community. The other banks, they're not just dealing with rising compliance costs. That's what's kind of kicked all this off. But there's another problem for the real small banks that has developed, and that's the cost of technology and upgrades that you need to compete in what is an ever increasingly mobile world. Customers, particularly millennials, are demanding technology, banking on the go, the ability to bank without ever going in the branch. They want all the bells and whistles. Bells and whistles cost money. Now, you've already got kind of a sluggish economy. You've got all these regulatory costs that have been piled on. And now they're telling you you need to upgrade your technology across the board at a cost of millions of dollars. They don't have the money. So they're nice little banks. They've got solid balance sheets, good loan portfolios, but it's going to be almost impossible to turn a profit. So they're going to have to sell. That's just the reality of it. There's lots of regional banks out there and larger community banks that are looking to grow past that $1 billion survival point that some of the analysts have talked about. And the only way to grow, realistically, in a sluggish, kind of slow, moving along economy, that's definitely overbanked with a branch, on every corner across the United States, is to acquire a smaller bank. It's happening. It's going to continue happening for an extended period of time, and there's a tremendous amount of money to be made here. So, anyway, by the way, speaking of that, I'm up to the third issue on timmelvin.com of Compelling Evidence, where I just list from the recent news comments by bank CEOs and other executives, industry professionals, consultants to the industry, bank stock analysts, the bank stock investors, where they talk about what's going on in the banking industry. You can find all three reports, Compelling Evidence, at timmelvin.com. Go take a look at it, because it's one thing for me to say it. It's one thing for a whole bunch of other smart people to be saying the exact same thing. And we included a quote, by the way, from Charlie Munger at the Daily Journal meeting earlier this year, where he said it's not going to be as easy. You're not going to have the 10% tailwind investing in larger cap stocks. And the people that are going to do real well investing going forward are those that find an inefficient market and become extremely adept and knowledgeable about investing in that market. That's small banks, folks. We have a tremendous edge here. You should be using it. Anyway, check out the Compelling Evidence reports at timmelvin.com. Anyway, we made some big changes in the bottom decile report recently. First off, we changed the name. It's now the Deep Value Report. It'll still come out every month, but we've kind of standardized some of what we're doing. Every month, you're going to have the Ben Graham two-factor portfolio based on an interview he gave shortly before he died, where he revealed that he thought you could buy stocks at a low PE ratio, the inverse of twice the AAA bond yield, or 10. So we're using 10 or less on the PE ratio, and the debt to equity on the balance sheet. And he hand tested it and performed quite well. He also, in another interview, the second of the two interviews he gave before he died, he revealed a 10-factor model for success. And this one I took and tested all 10 components. We found 3 that really worked the best, and that was the price to book value, debt to equity, and high current ratio. Gave us a list of stocks that are trading below asset value and have a margin of safety in the balance sheet. So that portfolio will also be in every issue. At reader request, we're keeping things like the perfect stock screen. That's stocks trading below book value that are profitable, pay dividends, and have high current ratios and low debt levels. That's been a pretty successful stock screen for us over the years. We'll also keep the double cheap screen portfolio, and that's just stocks that trade at a low enterprise value to EBITDA and below book value. And we'll continue to identify those stocks that are trading below book value and have insider buying. And of course, 4 times a year, and we're going to get ready to start writing this one up this weekend, we will bring you the 13F edition of the Deep Value Investor. So if you sign up now, you will get that edition just the minute it comes out. And that's where we look at all the stocks below book value and cheap on other measures that are being bought by the world's best and brightest value investing oriented managers. So wealth of information right at your fingertips every month. You don't have to spend the thousands of dollars on screeners and research material. We're just going to pop it right out to you, and you can sign up at marketfi.com. And if you use code DVI, you get a 20% discount. So you get that delivered to your inbox every month for just $79.20 a year. It's quite a bargain. And we made a couple changes to the monthly banking and profits report as well. In addition to the screens and commentary that we ordinarily put in the copy, I'm including 2 focus banks each and every month. These are smaller banks around the United States that I think are worth investigating as either potential dominant banks in their local market. We had one of those in this week's edition, or banks that are they're small, they're well run, they've got good balance sheets, decent loan portfolios, but they're susceptible to a takeover. And we're also, as they come up and pop up on the radar screen, if we see turnaround candidates where we think a bank is not such good shape today, but can make great strides forward over the next year or two. We'll be putting those in as focus bank selections in each edition of the monthly Banking on Profits report, along with all the normal stuff that we did, insider buying in undervalued banks. This week I ran a special screen that's going out in this week's edition. Comes out later this week, of banks with excess capital, because it's one of the things that FJ Capital identified as a feature of a likely takeover candidate. So we screened out stocks below book value that had high equity to asset ratios, included that in the edition. So the information there that allows you to take advantage of the trade of the decade, kind of steers the path of where you need to dig deeper to find the very best bank stock ideas. And again, that's just $97 a year, so you can sign up at marketfi.com, and I hope you do. We'd love to have you join us. Anyway, we've been doing an enormous amount, and by we I mean me, and the dog kind of hangs out on the floor, of testing and research lately. Now, I'm not a great database guy. I'm not a programmer, so when I dig into all this, well, if the dog could speak, it would know a whole lot of interesting new words. But we've had some fun with it over the last month, and we've piled up a ton of evidence, and it's supported by previous academic research and remarks from folks like Charlie Munger at the Daily Journal meeting. Individual investors, folks that, you've got other jobs and professions. You go into work, you're a plumber, an electrician, a doctor, a lawyer. You work at a corporation as a vice president, you're a salesperson, whatever. You've got a regular job. You've got kids, hobbies, other concerns, things that you like to do, maybe play around with golf on the weekend or spend time with your kids, but not just jammed into your office trying to draw lines and on stock charts and find wonderful new systems. For the guy who's just invested their money, they want to make a lot of money in the stock market, but they don't have the 12 to 15 hours a day that the pros devote to trading and investing in the stock market. The evidence overwhelmingly shows that you folks should be concentrating on less liquid securities. Don't compete against Fidelity trying to trade your 100 shares of Apple. Find stocks that are statistically cheap, have sound balance sheets with a significant margin of safety in that balance sheet, and hold them until they improve. Find those stocks that can survive until they thrive. Hold a portfolio of those. You don't need to be trading or hooked up to your computer all the time. Live your life, do your job, build your career, and allow the value and time of smaller, value-oriented securities to work for you. You should end up beating the market consistently over a period of time throughout your lifetime using that approach, and you're not dug to the desk trying to find a magic system every moment that you're not devoting to actually going out and earning money in your career. The evidence is powerful. It's huge. And by the way, if you look, I've shared the Roger Ibbotson study several times now, but just to reiterate, he found that over an extended period of time, from back in the 70s up through about the end of 2011, I believe the study ran, focusing on the most illiquid stocks with value characteristics earned you about 18% a year, while owning the growth stocks that were the most liquid actually earned a return of about 2% per year over the same period of time. You should be up here. Everybody's down here. You need to bring your portfolio over to this side of the ledger, guys, and focus on smaller, less liquid securities that are trading at a discount to either their asset value or their earnings power. It works for you. You should be doing it. We're here to help you doing it. I hope you'll take us up on it. Anyway, another busy weekend coming up. It's 13F season. The filings are starting to trickle in. We're starting to go through them. We looked at Tweedy Brown, one of our favorite long-term value investing firms. They were Ben Graham's original stockbroker, so they've been around a little while. And of course, Kahn Brothers, now that Irving Kahn has passed, his son is running the firm. And we looked over this, and they were remarkably inactive in the quarter. They really just didn't do a lot. Our friends at FJ Capital, the bank stock specialists, they were pretty busy. It's worth your time to go to sec.gov and take a look at what they were doing. Well, of course, you could just subscribe to our reports and we do the work for you. But if you want to do it yourself, sec.gov and dig up their latest 13F, compare it to the prior quarter, and you'll see what my friends at FJ Capital have been up to. Some interesting picks this time. And Arbiter Partners, Paul Isaacs, that's Walter Schloss's nephew, and Mr. Isaacs' dad actually worked for Max Hine at Hine Securities. So he's got a little bit of a value pedigree and an impressive track record. He put up his 13F this morning. Been through it, wrote an article about it that'll be on Real Money later today, outlining some of his picks. Very much in on the trade of the decade in small banks. He held all of his banks. He's got about a dozen of them in the portfolio, and he bought 4 new ones in the first quarter of the year that are attractive bargains trading below book value, and most of them have activist involvement. So he's very much involved in the trade of the decade. He's also got some tremendous short selections on some of today's high flyers. The guy's done real well on the short side, and he definitely has the courage of his convictions, shorting some of these high momentum stocks. He also bought a really interesting business development company and a mortgage REIT that are worth taking a look at. So again, we can either do the work for you, or you can go to sec.gov, pull up Arbiter Partners' most current filing, compare it to the fourth quarter of 2014, and you'll see what one of the smartest and most successful guys has been up to in what many are calling, fairly difficult market right now. Anyway, that's about it for this week. I'm going to try to get the video out over the weekend, but with crazy weekend coming up, the daughter flying in next week, it could be Monday or Tuesday of next week, but I will do my best. Have a great week, everybody.